Okay, let's unpack this. Welcome to the Deep Dive, where we tear into corporate earnings calls to find the signals in the noise. Today, we are all about Vistra Corp's third quarter 2025 results from their November 6th call.
And we're really focused on one big question for you today. Does Vistra's long-term strategy, this whole scale and secure thing, actually line up with the short-term financials they just put out? We're looking for proof that they're building real value here.
And right away, you see this fascinating contradiction in the numbers, because the market's reaction was, well, pretty lukewarm. The stock closed down about 2.5% after the release, which suggests investors saw something that gave them pause, even if the big story seems intact.
Yeah, and I think that pause is maybe based on a misreading of the headline numbers. Honestly, the tone of the call itself was what I'd call, constructively neutral. They were all about execution, not hype.
All right, so let's hit those headlines because they were all over the place. On one hand, you have adjusted earnings per share coming in at $1.75. That just crushed the consensus of $1.20. I mean, a 55-cent beat is huge.
It's massive. But then you look at revenue. They reported $4.97 billion, missing the consensus of around $6.12 billion.
Wait, so they missed revenue by over $1 billion.
A staggering $1.15 billion chasm, a 21% decline year over year. But, and this is the key, the core operational metric, ongoing operations adjusted EBITDA, that was up 10% year over year to $1.581 billion.
Okay, let's stop right there. That's the elephant in the room. How on earth do you miss revenue by that much and at the same time beat your most important profitability metric? This is the core insight we have to figure out.
Right. It boils down to two pretty technical things, mark-to-market accounting and just how incredibly effective their hedging program is. Management pointed directly to lower unrealized mark-to-market or MTM gains for that revenue miss and the lower GAAP net income.
Okay, for anyone listening who doesn't live and breathe power trading, can you break that down? How does a non-cash adjustment create such a huge gap between the revenue number and the actual, profitability?
Absolutely. The easiest way to think of MTM is just paper noise. So when Vistra hedges its future power sales, say, for 2027, they have to record the value of that future contract on today's books.
Okay.
If power prices fall between now and then, they take an unrealized loss on that contract today, which hits their GAAP revenue, even though no cash has changed hands. Last year, they had huge MTM gains. This year, prices just move differently.
So the messy revenue number was basically misleading. It was polluted by these unrealized non-cash adjustments. But the actual core business of generating and selling power for immediate cash was strong.
Precisely. The strength was almost all from the generation segment. It kicked in about $1.54 billion of that adjusted EBITDA. Retail was just $37 million, which is totally normal for Q3.
So what drove that generation strength?
It was the hedging. They explicitly said their average realized prices were over $10 per megawatt hour higher than Q3 of last year.
Wow, a $10 premium. That's not just risk management. That's generating alpha. They're turning a volatile commodity into a predictable, almost utility-like revenue stream. That makes this story much more investable.
It does. And you can see that confidence reflected on the balance sheet. Liquidity is super strong at $3.7 billion. With over $600 million of that in cash. This is the foundation that lets them execute the scale part of their strategy.
And that strong balance sheet is key to their big goal, getting investment-grade credit ratings.
Correct. They're sitting at a net leverage ratio of about 2.6 times. And they expect to bring that down even more organically, through higher earnings and cash flow through 2027. It's disciplined.
So that brings us to the scale and secure strategy in action. This quarter was full of big moves that seemed to justify their whole outlook. Let's start with scale. Where are they adding capacity?
They're doing it in two ways, buying and building. And they're targeting the fastest growing areas. First, they closed that acquisition of 7 natural gas plants from Lotus. That adds about 2,600 megawatts of flexible capacity.
That's scaled through acquisition. But what about what they're building themselves? That shows real conviction.
Absolutely. They committed to building 2 new natural gas units out in West Texas. It's another 860 megawatts. And the timing is critical. It's scheduled for early to mid 2028, aimed squarely at that massive Permian-driven load growth in ERCOT. And management was clear. These projects are targeting returns in the mid-teens. This is highly profitable capacity.
Okay, so that's scale. Now for the secure part, locking down their existing assets. This is where that Comanche Peak announcement feels like a real centerpiece for the whole long-term story.
It's a transformative event. a 20-year, 1,200 megawatt power purchase agreement, a PPA, at their nuclear plant. I mean, this gives them the financial backing to keep that plant running, potentially, well into the 2050s.
It sounds great. But what does a 20-year nuclear PPA actually mean for how you value Vistra?
It dramatically de-risks the asset. Nuclear plants have high fixed costs, right? But once you lock in a 20-year contract for a huge chunk of the output, you turn that asset from a merchant risk, dependent on daily spot prices, into something that looks more like an annuity. It's stable, long-term, contracted cash flow.
And that security feeds right into their hedging visibility, which is just incredible. They have something like 90% of 2025 generation hedged, 96% for 2026, and already 70% for 2027. I mean, how rare is that kind of forward visibility?
In the unregulated power sector, it's exceptional. And that's what gives them the confidence to issue multi-year guidance, which, leads us to the biggest kicker from the call, that massive step up they're projecting for 2026.
Hold on, let's talk about that. That 2026 guidance, they're projecting adjusted EBITDA of $6.8 to $7.6 billion. That is a nearly $2 billion jump from 2025. The market's modest reaction makes me think people feel that number is almost too good to be true. What makes it credible?
It's credible for three reasons, and they all go back to execution. First, those hedges we just talked about. They've locked in higher prices that they'll realize in 2026. Second, the Lotus acquisition. You get a full year of EBITDA from those 2,600 megawatts in 2026 versus just a partial year in 2025. And third, they specifically said that even without Lotus, the 2026 midpoint is ahead of where they thought it would be. So the underlying market is improving too.
And that huge jump in profit flows directly to the metric we really care about: adjusted free cash flow before growth, or FCFBG.
Exactly. The 2026 guidance is targeting, $3.9 to $4.7 billion in FCFBG, and then 2027 is even higher. They're basically projecting that FCFBG per share will grow by about 50% from 2024 through 2026.
Can we define FCFBG for a second? Why is focusing on free cash flow before growth spending the best way to look at a company like Vistra?
Because FCFBG is the pure cash the business generates before they make choices about where to spend it, like on those new Texas plants.
Yeah.
It tells you exactly how much money is on the table for paying down debt, for dividends, or, and this is key for Vistra, for share buybacks.
So what's driving all this underlying optimism? It has to be the sector tailwinds, right? This huge structural shift in power demand.
That's the connection. It's not cyclical. It's a structural demand spike. It's driven by electrification, AI, data centers. Load growth in ERCOT is running at 6% a year. Even PJM is seeing 2 to 3%. I mean, think about the scale here. The new demand in ERCOT alone over the next few years is like powering a whole new city like Boston just with data centers.
Right. Management said the number of planned data centers has more than doubled in the last year.
And ERCOT and PJM are getting the lion's share. This creates what they're calling a nuclear and natural gas renaissance. And Vistra owns both. All of a sudden, their flexible gas plants aren't legacy assets anymore. They're premium assets needed to back up renewables and power all this new infrastructure.
So that scarcity is being monetized through the PPA and the new builds. And it's all supported by this relentless focus on capital return.
It's the ultimate amplifier for shareholders. Since late 2021, they've bought back over $5.6 billion in stock. That's reduced the share count by about 30%.
Shrinking the pie while growing the cash flow. And they just added another $1 billion to that buyback authorization.
Yep. And they're not done. They're even looking at nuclear upgrades at Comanche Peak that could add another 10% to capacity in the early 2030s.
And you can tell they're getting swamped with inbound interest from customers because they're having to staff up just to handle it.
Right, they're spending an extra $50 million a year just on development activities. That's not maintenance. That's spending to chase new contracts, new PPAs, new builds. It's a hugely bullish internal signal.
Okay, we've covered the financials, the strategy, the tailwinds. Now let's pivot. It's time for the segment where we let the analysis run a little hotter.
And this is your critical reminder. This next part is for entertainment and discussion only. We are not your financial advisors. Please do your own homework before making any investment decisions.
Absolutely. Okay, pitch to the investment committee. The outrageously plausible trade idea is this. We initiate a long position in Vistra Corp equity, ticker VST.
And the thesis is pretty simple. We're betting that Vistra's combination of 1, aggressive capital return, and 2, their highly contracted growth is going to force a major re-rating against the rest of the utility sector. The market right now is just not believing that massive 2026 step up in profitability.
That recent lag where VST actually underperformed the XLU utility index, that's our entry point. The rationale is anchored by the 50% growth in adjusted FCFBG per share through 2026, which is super visible because of the hedges. And that 2026 EBITDA guidance of $6.8 to $7.6 billion is basically locked in.
Which makes Vistra a leveraged play on power fundamentals, but without all the normal commodity risk. Plus, that 30% reduction in the share count just provides incredible capital efficiency. Every dollar of cash flow is magnified for the remaining shareholders.
So the actionable idea is a pair trade. Go long VST and short a slow growth utility peer, or maybe just the whole XLU index. We think Vistra's execution will close that recent pricing gap and drive some serious outperformance as we get closer to that 2026 window.
So to recap our deep dive here, Vistra showed really strong operational metrics in Q3. You got that big adjusted EBITDA beat, you got the high hedge percentages, and that was despite a very confusing revenue miss that was just driven by non-cash accounting noise. They're executing a clear strategy, securing long-term contracts like at Comanche Peak and investing smartly in new gas plants in West Texas.
So what does this all mean for you, the listener, for the long-term story?
Well, the market's reaction was soft, probably because people are skeptical about that huge 2026 jump. But the underlying data, the cash flow, the buybacks, it points to a company that's positioning itself to deliver explosive value over the next 2 years, for sure. And that confidence from management, plus the sector tailwinds, it all sets up our final provocative thought for you to think about. Management expects to generate about $10 billion in cash through the end of 2027. After their current plans, they figure they'll have about $4 billion of extra capital available. So the question is, how much of that excess $4 billion will they need for a big M&A deal versus how much will actually come back to shareholders? Where does that money ultimately get deployed?
That $4 billion decision is the inflection point that's going to define Vistra's entire trajectory through the end of the decade. We appreciate you diving deep with us today.